Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, August 23rd, 2024. A week ago, I observed that retail sales in July increased 1% over the previous month, which was far higher than the 0.4% gain widely anticipated. The implications of that unexpected surge in spending became evident 2 days ago when big box retailer and PF income portfolio holding Target released its fiscal 2024 Q2 results, and I have that page showing here and a link to it here in the body of the article. Those numbers included a 2% increase in comparable sales, led by an 8.7% rise in digital or online sales. Target recorded $25.5 billion in total revenue, which was 2.7% higher on a year-over-year basis. The net result was a 36.6% jump in net operating income, which is why earnings per share shot up from $1.80 a year ago to $2.57 this year during the second quarter. So that's a big jump in earnings per share that Wall Street was really not prepared for at all. Now that news came on the heels of a similarly successful quarterly report from the nation's largest retailer, Walmart, the previous week. During its fiscal 2025 second quarter, Walmart increased consolidated revenue by 4.8%, led by a 21% gain in global commerce sales. Now that's the kind of news that Wall Street likes to hear, not only for Target, which gained more than 10% that day on huge trading volume, but also for the entire retail sector. Now here's Target's chart. This is over the past 2 years, because over the past 2 years, basically it's gone nowhere. Now the past 2 years, of course, encompasses most of the time that the Fed started raising rates. I think it was March of 2022, and this only goes back to August of 2022. But nevertheless, during this period of higher interest rates, Target share price has not gone very far. But if we zoom into year to date, and you can see that it's peaked back in April, but look over here to the far right during the past month, you can see this big jump. So appears to be a reversal in Target's trend. And by the way, if we look at Walmart, after they posted their results, again, look year to date, and it's been having a good year all along, but then look at that jump here. And what's good for the retail sector is good for the entire stock market, since consumer spending is the engine that drives the American economy. At the risk of igniting a political firestorm, I feel compelled to make what I believe is an objective observation. Regardless of how anyone feels about so-called Bidenomics, the simple fact of the matter is that the American economy is on a roll. Consumers are spending, gross domestic product is expanding, and all the major stock market indexes are close to their all-time highs achieved last month. So here's the latest consumer spending report. Now we'll get another one here in a week, next Friday. So these numbers are a little dated, but nevertheless, solid consumer spending. Now here's gross domestic product. You look over the past 6 quarters, bottomed out during the first quarter, and then the rate of growth in GDP doubled during the second quarter. So we won't know until sometime, I guess in October, how the third quarter went. And then here, but that begs the question, why is consumer confidence not also on the rise? 3 weeks ago, the Conference Board reported that its present situation index, which is based on survey respondents' assessment of current business and labor market conditions, fell in June. Bear in mind, this survey does not directly address food prices, which is a valid complaint about the economy that many people have. At the same time, the expectations index, which measures respondents' short-term outlook for income, business, and labor markets, improved in June. So the present situation index went down, while the expectation index went up last month, and that's kind of interesting. According to the press release accompanying that data, which is what we're looking at here, even though consumers remain relatively positive about the labor market, they still appear to be elevated. They appear to be concerned about elevated prices, and this gets back to the food prices I was talking about a minute ago, and interest rates, and uncertainty about the future, things that may not improve until next year. The interest rate piece of that equation may improve as soon as next month, when the Federal Open Market Committee is expected to reduce its policy rate by at least 1/4 of a percentage point. If that has the desired effect of spurring economic activity, then that may also alleviate concern about the strength of the jobs market. So that remains to be seen, But that's this week's PF video update, and I look forward to talking to you next week. Thank you.